A lawyer just handed you a check for $250,000. Your uncle is dead. You're sad. And you're suddenly the richest you've ever been in your life. What do you do in the next 10 minutes? Here's a hint. It's not paying off your mortgage. It's not maxing out your TFSAs. It's not calling your kids to tell them about the cottage. Most people make their worst money decisions in the first 90 days after an inheritance, and they make them fast. I'm going to walk you through the 5 moves that separate the people who turn $250,000 into a changed retirement from the people who blink and it's gone. Stick around for move 5. I'm going to show you 2 people who inherit the exact same $250,000 and end up with 2 completely different lives. Let's slow the play down. Move 1. Freeze the puck. Do not make an irreversible decision with this money right now. That doesn't mean stuffing the check in a drawer. It means parking it somewhere safe while your head clears. An inheritance shows up wrapped in grief, guilt, and pressure, all at once. You might feel like you owe it to the person who left it to you to do something big. You might feel guilty for having it all. None of that makes you irrational. It makes you human. But it's exactly the state of mind that leads to expensive mistakes. For the first 60 to 90 days, don't invest all at once. Don't pay off the entire mortgage. Don't buy a property. Don't hand out large sums to family. Don't quit your job. Don't make a major purchase. You're not trying to time the market here. You're separating the emotional event from the financial decision, and those are 2 different things. Park the money in a high-interest savings account or a cashable GIC. But watch out your coverage. CDIC generally protects eligible deposits up to $100,000 per category per institution. So dropping the full $250,000 into one account at one bank does not automatically mean it's all covered. Ask the institution directly because the rules depend on how the money is structured. Right now, you're not chasing returns. You're buying yourself time. Move 2. Know exactly what landed in your lap. For this example, we're talking about $250,000 in cash, fully distributed after the estate is settled. But inheritance rarely show up that clean. You might instead inherit a non-registered investment account, a TFSA, an RSP or RIF, a house or cottage, shares in a private business, foreign property, or life insurance proceeds. These are all not interchangeable, and they're not taxed the same way. Here's the part most people get wrong. Most gifts and inheritance aren't taxed as income to you, the beneficiary. But that doesn't mean death is tax-free. When someone dies, in Canada generally treats them as having sold everything they owed the moment before death at fair market value. That can trigger capital gains on their final tax returns. Before you treat this money as fully yours, ask, has the estate actually been settled? Has the executor covered the estate's taxes and debts? Is the distribution final or just an interim payment? Did you receive cash or an asset? What's the adjusted cost base if you receive property or investments? Are there foreign reporting issues? If you're also the executor, be extra careful about distributing money before the estate's bills and taxes are handled. Executors and beneficiaries might be the same person, but they're 2 very different jobs. This is where an accountant and an estate lawyer earn their fee. Move 3. Build a firewall around the money. The second people find out inherited money, the pitches start. A cousin has an investment, your kid needs help with the down payment, a friend has a can't-miss rental property, someone wants a loan. You also start pitching yourself. I should enjoy some of this. I should invest all of it right now. I should get every child the exact same amount. None of those ideas are necessarily wrong. The problem is they're showing up before you decide what this money is actually needed for. Use one line every time. It's being held while I finish my financial and tax review. I'm not making any commitments yet. That's not selfish. That's the job. Keep the money in its own account, separate from everyday checking. That gives you a clean line, both mentally and administratively. And if you're married, common law or separation is even a possibility, Get legal advice before you mix this money into a joint account or joint property. How family property gets treated varies by province, and it can depend entirely on what you do with the inheritance after you receive it. Don't run this part on advice from a friend or a video you half watched. Move 4. Give every dollar a job. Stop asking, where should I invest $250,000? Start asking, what job does each dollar need to do? Bucket 1. Stability. Is your emergency fund solid? Any big expenses coming up in the next 1 to 3 years? A roof, a vehicle, a parent who might need support. Money you'll need soon shouldn't sit in the same risk bucket as the money you won't touch for 15 years. Bucket 2. Expensive debt. Look at the rate and terms on everything you owe. Credit card debt and high interest unsecured debt usually gets paid down fast once the rest of the plan is clear. A mortgage takes more thought. Paying it down guarantees you a return equal to the interest rate, but it also eats your liquidity. Always pay off the mortgage is not a good plan. Neither is always invest, because markets win long term. Your rate, renewal date, prepayment room, and retirement timeline decide this, not a slogan. Bucket 3. Registered accounts. Check your actual TFSA and RSP room. Don't guess, and don't assume the $250,000 can go into your TFSA just because it says tax-free in the name. Over contributions, and you're generally taxed 1% a month on the excess while it sits there. A big RSP contribution isn't automatically smart either. The deduction is worth more in a high income year, and withdrawals later show up as tax income. The right move depends on where your tax rate sits now versus later. Bucket 4. Long-term investing. Whatever is left after stability, debt, and registered accounts can go into a non-registered account, built around your timeline, your required return, and how much risk you can actually take. This money doesn't get its own strategy. It joins the rest of your portfolio. Bucket 5. Life and legacy. It's completely fine to use part of this for something that matters. A trip, help for a child, a gift to charity, something that honors the person who left it to you. Just set the number first. Say 5% or $12,500 goes to enjoying or giving, and the remaining $237,500 goes to the plan. That way, the money can improve your life today without one emotional purchase swallowing the whole opportunity. Move 5. Run it against the whole game plan. This is where the real value shows up. Don't ask, what can $250,000 buy? Ask, what can $250,000 change? Picture 2 people, both 58. Both inherit $250,000. Both hope to retire at 65. Person 1 deposits into their regular bank account, renovates the kitchen for $70,000, gives $30,000 to the kids, buys a $50,000 vehicle, invests the remaining $100,000 without touching their retirement. None of that is inherently wrong, but 7 years later, the money is mostly gone, and retirement looks almost exactly the same as it did before. Person 2 takes 90 days first, keeps $20,000 as extra emergency and home reserves, sets aside $15,000 for a meaningful trip and some gifts, uses $65,000 to wipe out expenses, debt, and make a mortgage prepayment within their allowed limits, puts $50,000 into registered accounts based on actual room and tax strategy, invests the last $100,000 as part of one coordinated retirement portfolio. Then they rerun the numbers. Lower debt means lower required retirement spending. More invested means more future income. A planned contribution strategy means better tax efficiency. The inheritance didn't just pay their account balance. It may have moved their retirement date up, cut their financial risk, and improved their monthly cash flow for decades. That's the gap between receiving money and integrating it into a plan. If $250,000 lands in your lap in Canada, here's the order. 1. Pause every permanent decision and park the money somewhere safe. 2. Find out exactly what you inherited and whether the estate and tax work is actually done. 3. Build a firewall before you make any promises or mix the money with anything else. 4. Give every dollar a specific job. And 5. Run it against your complete financial and retirement plan. The worst inheritance mistake is almost never picking the wrong fund. It's making a string of disconnected decisions before deciding what the money is even supposed to change. If money is moving in your life, this channel is built for exactly that moment. I help Canadians slow the play down, understand their options, and build real game plans before they make an expensive, irreversible move. Subscribe if you want straight talk on inheritance, severance, pensions, business sale, and retirement. The next question people always ask me: should you use the inheritance to pay off your mortgage or invest it? That comparison is more complicated than lining your mortgage rate up against an expected return. I break down the full math in the next video. I'm Brett, and this is Money in Motion.